Okay, here's a quick little summary of Chapter 12. I'm not going to cover everything in the chapter, but this will give you a nice overview and hopefully help you on know what to focus on. We started out talking about the three types of businesses, and you may have had these in other types of classes. The first being a sole proprietorship, where we just have one owner. That's really what we covered in Accounting 101. Everything we did there was a sole proprietorship. The second form is a partnership, and that's what we're going to talk about in this chapter. And then the third form is a corporation. That's what we're going to talk about in Chapter 13, and so we'll kind of talk about the pros and cons of these. A subset there is an LLC, which kind of combines the best of the partnership and the corporation. But we're going to talk about partnerships right now, and a lot of times this could be two people get together to start a business, or two people with sole proprietorships combine them into one business, and they should really have a written agreement. This is sort of like the prenup for a marriage, and a partnership, and a lot of times is like a marriage, but they'll have written articles of partnership, or they should. They don't have to, but they really should. And these will help iron out how different things will be handled, and this will actually, if these are done and done well and thoroughly, this will eliminate a lot of problems going forward. So let's talk a little bit about the characteristics of a partnership compared to some of the other forms of business or ownership. It does have a limited lifespan. It's limited to the life of the owners, and really anytime you make a change, if somebody leaves or somebody else comes in, you're essentially dissolving one partnership and starting up another one. So that's one factor. It can't go on if the partners don't, unlike a corporation that would. Another factor here is what we call mutual agency, and this means that any partner is, think of it as a legal representative of the firm. So one partner can enter into a contract or take on debt without necessarily getting the permission of the other partners, but the partnership, the business, is bound to that. The other partners can't say, well, I had no idea about that, so I'm not honoring that contract. So they, any one partner can bind the business to obligations and debt and that sort of thing. One of the biggest disadvantages of a partnership is unlimited liability. And this means there's really no separation as far as liability between the owners and the business. So if you own a sole proprietorship or a partnership and somebody sues your business, they can not only take what the business has, but they could come after your own personal assets. That's the biggest drawback there, that there's really no limit. So you could lose your own house and car and savings and all that kind of thing. There's really no separation here, whereas a corporation there is. We also have co-ownership of assets. So if I contributed a building or cash or something to the partnership, to the business, it's not mine. I can't say, well, that was mine in the first place, so now the business owns it and we all own it equally. One of the biggest advantages is that the partnership is not taxed, just the owners is not taxed. So corporations have to deal with what we call double taxation. The corporation pays taxes, then whatever's left over they turn over to the owners, and then the owners are taxed on that, so it's taxed twice. And a partnership doesn't have to deal with that. The partnership isn't taxed, just the owners. This is where the LLC comes in, because they have the limited liability, so they get out of this drawback, but they're taxed like a partnership. So they get kind of the best of both worlds there. Now there are some limits to that. Only businesses of certain sizes can do that, and you can't issue stock, and there are restrictions in different types of those. But overall, you get to protect yourself for the liability, but you don't have to pay taxes like a partnership, which is why you see so many of those. Some other things about a partnership that are kind of new. The partners will share responsibility and decision making. How they share that is really, there's no one right way. It's up to them. Sometimes somebody will say, I'm a silent partner, I'm contributing money, you run the business how you want. Sometimes, everybody's hands-on. This can be a good thing and a bad thing. Sometimes it's nice to have somebody to bounce ideas off of, but then sometimes if you're used to running a business yourself, you're not really used to having to share the decision-making process. So this can be kind of a pro and a con. A partnership can raise more capital because now you've just got more people putting in assets or that kind of thing. So you can raise more capital than a sole proprietorship. And there's also more skills coming in. So the same way the sharing the responsibility and decision making can be a pro or a con, this can be a big advantage here. It's kind of the advantage of the multiple people here, because let's say I know everything there is to know about running a restaurant, but I don't know anything about running a business. And so I bring in somebody who's an expert on that. And now we've got this shared skill set, so we're not limited to just mine. So if everybody's working together, this can be great. It can also cause dissension because people can have different ideas about how the business is going to go and the direction it should take and those kinds of things. So again, in that way, it is a lot like a marriage again. So sometimes these work out great and sometimes they don't. But the more you decide things ahead of time in those articles of partnership, the less headache you'll have going forward. Okay, so when we form a partnership, if you remember back in Accounting 1 when we started a business, almost always the first transaction you would get. So let's see, for a proprietorship, we would debit cash and credit the capital account, right? Credit so-and-so capital as the owner contributes to the business. It's the same thing now. With a partnership, we do the same thing. We'll debit cash or other assets if they can bring a building or something like that. They might also be bringing liabilities along, so we would credit the liabilities, and the difference would be the capital. So for each owner, we would have this same type of thing, and so the assets they brought along minus the liabilities would equal the capital they would have in the business. And then, so if I have 3 partners, I might have 3 entries like this to form the partnership, but then on the balance sheet, they would all be combined. So it's not the cash that partner A brought and the cash that partner B brought separate. It's all lumped together into one cash account. The other thing is that all non-cash assets, so buildings, equipment, furniture, vehicles, anything like that, all non-cash assets will be brought in at their market value, not their book value. So use current market value, not the not whatever it was. Like if it was coming from another business, we don't use what it was on their books. We'll have to reassess everything as we form this new partnership. So if you look in the demo problems, there's a couple different problems there. Let's see, there's 2 or 3 problems there on forming a partnership. Those are good practice before you get to the homework. The next thing we have to know is how to divide the net income or the net loss. And this, if there's no partnership agreement, if they did not come to an agreement at the beginning about how this is going to be shared, then the net income or the net loss is just split evenly among the partners. Most of the time, though, hopefully they will have an agreement, and this can be divided up in a number of ways. So I'm going to go the order that you would use, but they might not. Every partnership is going to have this order. So the first thing you would pay out is return on capital balances. They would decide that out. So if I own 50% of the capital, then it might say the first $30,000 will be based on capital balances. And so if I have 3 partners that have 50%, 25, and 25 like that, then the one guy would get 50% of the 30,000, the other guy would get 25, and the other guy would get 25. And so we do it that way. The second thing that I would do is if I'm paying a salary allowance. Now, I might not do that, but I might have, one guy might be getting more on this return on capital balance, and then another guy might not have much in capital, but he's the one that's running the business and putting all the time in. So maybe I pay him a salary. So that would come out next. If there's any bonuses, we would pay those out, and we'll get to bonuses a little bit later. But then the fourth thing, then any remaining amount. So after I've paid out the whatever I've set to return on capital balances, whatever salary, any remaining will be split according to the ratio in the agreement. So you might see it, they might say the remainder is split evenly. And so then you say, all right, here was their net income minus whatever I gave out here, minus whatever I gave out here. So whatever's left is this one, minus whatever I gave out here. Sorry, that's hard to read. Net income. Whatever's left will be split according to the ratio. So it might say I'm just going to split this evenly. Sometimes you see a ratio that would be like this. It would be like let's say I have 3 partners, and they're going to split it on a 2-3-2 ratio, something like that. The easiest way I think to do this is to say I've got 2 parts, 3 parts, and 2 parts. So I've got 7 parts total. So I would take what's left, divided by these 7 parts, and I would get, let's say, I don't know, $100 equals 1 part. Let's say this was $700 left. And so then I would give 2 parts to this guy, 3 parts to this guy, and 2 parts to this guy. So it would be 200, 300, and 200. That's how I would split up this ratio. So there's other ways to do this. You know, you can do it in percentages, but I always think this works. If you just take the ratio and add that up and get that many parts and say, all right, that's how I'm going to divide it up, and then this tells you how many parts each person gets. So there are, again, in the demo problems, several problems there where you can see different types of things and different types of agreements that they have. It's also possible that this remaining balance card could be negative. Let's say I only had an income of $50,000, but I gave $30,000 here and $30,000 here. So then this is actually a negative 10, and so I would take away from the people the same way I gave it. So there's several different problems in the demo problems, kind of shorter versions you can practice on in there. The next thing we have to do is know how to admit a new partner, and there are 2 ways this can happen. The first one is if the new partner is purchasing interest in the business, purchasing interest, or is essentially buying the capital from an existing partner. So purchasing interest in the partnership. Partnership. Sorry. From an existing partner. So Joe's leaving and Bill's coming in, and Bill just buys Joe's share of the business is essentially what this is. From existing partner. If this is the case, the business is not getting any money. Okay, so the cash that was paid for this is not relevant. Because the cash transaction, the guy that's leaving is the one that's getting the cash. And in this case, all I'm doing is just transferring capital from one partner to the other, from the old guy to the new guy. So the business isn't getting capital, and the journal entry is actually really simple for that one. Then I just credit one guy's capital and debit the other guy's. If, however, the new partner is contributing assets in exchange for capital. And so sometimes you'll see so-and-so paid $50,000 in exchange for 1/4 interest in the business, is contributing assets. A lot of times it'll be cash, but it doesn't have to be cash. The first thing the business has to do is revalue all the assets to their current market value. Again, we're pretty much starting over and forming a new thing to current market value, and then they would have to adjust the capital balances accordingly. in pretty much every problem we do in this book, you can just assume that part has already been done for you. So we kind of skip to part 2. All right. So part 2, you add in the new partner's contribution. This is how I do it. Add new partner's contribution to get total new capital. Then you will divide that by new total by ratio that they've agreed on. So let's say we had before the total capital before this transaction was $100,000. The new guy contributes $25,000. So the new total is $125,000. Okay, that takes us up to step 2. All right. Then step 3, you say, all right, and let's say he's putting $25,000 in to purchase 1/4 interest. So you would take that new capital times 1/4 to get the new partner's capital. Whatever that is. And so now you can the 4th step is this will give you the new partner's capital. The 4th part here is then to compare the new partner's capital with his contribution. If what he contributed is greater than the capital he's getting, then that means there is a bonus to the existing partners, which means their capital is going to go up. If what he is contributing is less than his capital balance, then that is a bonus to the new guy. And that has to come from the existing partner's capital. So he, let's say he's got a lot of clout and they really want him in this partnership. They're willing to give him more in capital than he's contributing. But the cash and the capital still have to equal, so the assets and the accounting equation still has to balance. So that means that the capital, the bonus that he's getting, has to come from the old partners. So their capital balances will go down. And so what you'll say is you'll take that bonus and you'll take that times the profit sharing ratio that they had, and that's how you know how much of that bonus to give to or take away from the existing partners. And again, there's several problems in the demo where you can see several different, you get to see, there's one where he's just purchasing it, there's one where there's a bonus to the old, and I think there's one with a bonus to the new. So you get lots of practice to see all of those. If a partner is withdrawing from a business, it's really the same process as admitting a new partner, just the mirror image of it. You can, the one partner can buy somebody else out, so the existing partners, one of the existing partners can buy them out, and then again buy out the, let's say, the departing partner. No cash to the business because that's between those two partners, and so again it's just transferring capital. So the business isn't getting or paying cash in that situation. The second situation, though, is that the business can kind of, let's say, cash out that partner. And again, the amount of cash they're giving him might be more or less than his capital, depending on a lot of things. Maybe he's desperate to leave, and so I can give him less. Or maybe this is a founding member, and I decided he deserved more than just his capital balance, so I gave him even more. So there's a bonus if the cash is not equal to the capital balance that you're closing out. And again, that bonus could be to the old or the new, or I should say the remaining or the departing, or It could be either situation depending on, a whole bunch of things there. But it would the same thing. You would reevaluate the cash, and so it works exactly the same way as admitting a new partner, just the reverse image. And then the last thing that we talk about in this one is liquidating a partnership. And so the business is closing completely, and the first thing you do is sell off all the assets. So I'm essentially converting all of the assets to cash, and I allocate any gains or losses to the partners based on the profit sharing ratio. The one from the original agreement. Now, the only asset I have is cash. I've sold off everything. The next thing I do is pay off any liabilities. And then if we look at assets equal liabilities plus owner's equity, right? The only asset we have is cash, and the liabilities are gone because I just paid those off. So now the cash equals the owner's equity. So then all I have to do is disperse remaining cash based on capital balances. And then everybody will have a zero, and every account will have a zero balance, and you're done. And again, there's a couple problems for you to do. I think there's just one problem in the demo where you do that one. So there's a summary of Chapter 12. I hope that helps a little bit. And again, I do recommend you work on those demo problems before the homework, or especially before the quizzes. So I'll post this one up there for you, and let me know if you have any questions.